I do think that we're going to see continued volatility. I do think that we're going to test the markets a little more. But every time we test these markets, they hold critical technical levels, as we've seen this week. And yesterday, with North Korea headlines once again, the market shrugged it off in literally a couple of hours. So I do think that you should be a little careful with your money, but I still am the believer that we go higher in the markets, and we probably still go with that old adage, never short a dull market. And if the volatility and liquidity are both in line, I think the markets could still rise.
I mean, the markets never really got all that much of a bang out of the idea that we were going to have peace talks with North Korea to begin with. I think markets have always been a little skeptical of dealing with what we know is a pretty volatile regime and kind of following through with this. We did see some upside, but you're only talking about a percentage point probably.
I think the markets sort of disregarded North Korea, not rallied on it, but it was another thing on the long list of things that the market has shrugged off.
Right. Steve, what do you think?
I think the market is getting used to volatile headlines, and we look more at the fundamentals. I think the market could chop sideways from here. Volatility is going to pop up. Last year was kind of a freebie for investors. You got fixed income rates of volatility for basically triple a reasonable rate of return in equities. You're unlikely to get that this year. So investors got paid last year for great earnings this year and a lot of the fiscal policy. But as the Fed normalizes policy, as earnings come off the boil going into next year, I think sideways in fixed income space and equity space in the U.S. seems reasonable. And for us, this is still an opportunity to look globally. Europe, emerging markets to some degree, commodities, Asia, where monetary policy and valuations are a little bit more friendly.
I'm glad you brought up interest rates, because it's probably no coincidence that interest rates, the 10-year fell back below 3% yesterday, and you did see the market stabilize as a result.
I think so. I think
these aren't big moves.
They're not big moves, but in this environment, small moves can have big information. So you're getting a bit of a rally in interest rates, but also I think sequencing. So a repricing of inflation risk, which was very appropriate coming into this year, especially given the fiscal policy. But then also as we move 1.5, 2 years out, as the yield curve flattens, as it will likely invert this time next year, I think we need to price in the probability that there's going to be a cyclical downturn in the U.S. somewhere in 2020. The global growth story tends to be strong right now, but even the composition of earnings in the U.S. seems to be an increasingly global story. So for us, this is more multi-asset, more global, and more active. I think the last couple of months will show that active has added value to U.S. and global investors.
And you're saying if you're going to be active, you would be directing people away from the United States?
I think both. Look at using some, 9 years of strong gains in the U.S. Diversify globally is kind of, the diet and exercise of investing. But our work also would support that as well. And then as a U.S. dollar-based investor goes globally, active can add more value in less liquid, less transparent markets in emerging, frontier, real assets, illiquid assets. And from a global perspective, that active budget we think can pay off more globally.
Grasso, what do you tell people to do right now?
So if you look at this is where I was going to push back with Stephen a little bit. When you look outside the United States and you're looking for, is that because there was an underperformance there? When I look at the IWM or the Russell and I look at where the corporate tax rates were at 35% and now we're looking at 21%, and a lot of these things are blended and you're not going to see an exact 21%, but that tailwind is hard to deny and it's really hard to combat when you're trying to look at maybe a lopsided outside the U.S. coming back here and exposed dollar, treasuries, and all of the above, when you have a clear-cut picture with small cap names that have an aggressively low tax bracket or effective tax rate that they haven't seen since 1941. So there's no way an analyst can calculate it. Forget about never being around in a rising rate environment.
So maybe it's more than a 6-month gain that you're talking about out of this?
Exactly. When you start to see it bleed through the numbers.
From an equity-only perspective, that would make sense. But if you take a broader multi-asset perspective, I think you get a slightly different picture. And if you layer on...
What does that mean?
So if
you're talking about higher... I mean, you're still only talking about the 10-year sitting just at 3%.
Oh, correct. But if we take a global perspective and from a U.S. dollar-based investor, I mean, this has been a great run. And I think there are opportunities right now based upon valuation, cycle, and global markets that for a U.S. dollar-based investor are very real, and just diversify away some of those gains. I think if you look at Europe, the Italian situation right now, we're at about 240 in the 10-year. I think the European Central Bank is going to be laser focused on that. Tremendous liquidity there, earlier earnings cycle. So when you start adding those up, it's not a bad opportunity to rebalance.
Can I just say, the Italian 10-year at 240 versus us at 290 or 3. I mean, that seems crazy. What would you rather own? Paper from the United States or paper from Italy?
I think paper from the United States. But the 10-year on Italy means that the European Central Bank's policy is going to be very accommodative.
Yeah.
Correct. So the likelihood that the European Central Bank is going to exit QE and aggressively renormalize, I think, is not terribly high. So that can be part of the broader opportunity set as well.
I agree with you at face value that it should, no matter what's happening behind the scenes, you should be buying U.S. paper versus that, and there should be a way different
You're talking about what it means for stocks.
Exactly right. Exactly right. Exactly right.
Yeah.
Not specific to that paper, but what that implies for the broader monetary environment.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.